All right. Good afternoon, everybody. Thank you for joining today's webinar. Today's webinar is on the One Big Beautiful Bill Act, presented by myself, Rob Premselaar, and Jonathan Donenfeld. So thanks for joining again. Please reminder to be on mute. If you have any questions throughout today's presentation, please punch them out into the meeting chat. And if we can, we will try our best to get to them throughout the meeting. Or at the end, okay? So, let me see here. The purpose of today's webinar, to talk about the One Big Beautiful Bill Act, which was signed into law by the President on July 4th, 2025, just last month. The bill locks in and makes permanent many tax benefits provided by the prior tax overhaul, the Tax Cuts and Jobs Act, also known as the TCJA, signed into law in December 2017. Many of those tax benefits and laws were effective 2018. Again, this One Big Beautiful Bill Act makes a lot of that permanent in nature. It also improves, expands, and enhances affordability and planning, adds new features, rolls back key incentives, and creates complexity requiring strategic timing and tax planning. We will be going through those. The goal in today's webinar is an introduction of these key individual business tax provisions. We will cover many of these details of these provisions, but it's only intended to be an introduction to our relevant viewers. Due to time constraints, we will not be covering all provisions, and we will not be covering all details. We will also be covering some IRS updates, specifically from John Donenfeld. He'll be providing us IRS updates, IRS staffing, and IRS collection and enforcement efforts. For further information on the new tax provisions and how they can relate, how they are relevant to you and your business, please reach out to your tax professional. If you're interested to speaking with John or myself, you can find our contact information at the end of this webinar.
And just one thing to add, Rob,
Sure.
For everyone, remember everyone's situation is unique. And so that as we go through things, some things may apply to you, may not apply to you, may apply to some businesses, but you really should talk to a tax advisor. You know, this is a general discussion, and everyone's situation is different.
Yeah, great. So today we're going to do some intros for myself and John. We're going to talk about the individual tax provisions, the business tax provisions, provide some IRS updates, and go over some Q&A. All right. So here are your presenters, myself, Rob Premselaar, CPA out of Clifton, New Jersey. I'm the founder and owner-operator of Premselaar CPA, providing tax compliance, tax planning, tax projections, business advisory to small to medium-sized businesses. We work on a wide range of industries, namely, primarily, we work with professional services, attorneys, medical practices, high net worth individuals, professional athletes, and self-employed individuals. We have staff on hand to provide bookkeeping, so take you all the way from the bookkeeping all the way up to the tax planning, tax strategy, and implementation. So glad to be here, glad to run this with John. And John, can you introduce yourself, please?
Hi, everyone. John Donenfeld. I'm a CPA. My practice is a little different. We focus on tax resolution, helping individuals and businesses resolve their outstanding issues with the IRS and state, and deal with all the fund notices and some of the things we'll talk about today. And looking forward to speaking with you guys.
Okay. So I wanted to start off with a high-level summary of the OBBB versus the TCJA. So the OBBB is about 900 pages long. There's a lot in here. And a lot of what's in here really is not going to change much of what you've experienced from a tax perspective over the last 6 to 7 years. There will be some modifications that will apply to many of you and many taxpayers, but there's a lot that will apply, but things will remain consistent as they were. So the TCJA signed in December of 2017 made a lot of tax laws effective for tax year 2018 from the prior existing tax laws. So, and then the OBB either makes them permanent or continues those tax laws that were set to sunset in 2025 or 2026. So, for example, the tax rate cuts prior to the TCJA, the highest marginal tax bracket federally was 39.6%. Now it's 37%. And so the tax rate cuts provided by the TCJA were temporary in nature. The OBBB comes in and makes those cuts permanent. The standard deduction, the TCJA doubled them from what they were. They were set to sunset, meaning they were supposed to go back to what they were prior to the TCJA. The OBBB comes in, increases them, and makes them permanent. Salt cap deduction. I'm sure many of you are aware of this, being that we're in New Jersey, $10,000 limit on all your salt taxes, state and local, that's state income tax and state property and personal property taxes. It was made temporary by the TCJA. The OBBB increases it temporarily, and it's way it's currently written phases back down. The incremental 30,000 gets phases back down to 2030. QBI deduction was introduced, was made temporary by the TCJA. OBBB makes them permanent and expands them slightly. Clean energy credits was actually expanded after the TCJA. OBBB eliminates them or phases them out in 25 through 28. Depreciation was TCJA introduced 100% bonus depreciation, and over a 5-year period brought it down 20% per year. And it was intended to completely sunset after 2026. OBBB takes that law, makes it permanent, and increases it to 100%. Estate and gift tax nearly doubled the lifetime exemption with an expiring clause in there. OBBB comes in and increases it. So we'll go through these a little bit more in detail, but again, a lot of these will continue what you've experienced over the last few years, but now continues it in the near future. Now, when something is made temporary versus permanent, I just want to say this. When something is made permanent, any new legislation, any new president can come in and change permanent, right? So yeah, it feels good when a rate cut is made permanent, but anything could be changed, right? So let's just keep that in mind, as we, continue on with our tax planning. Okay. So individual tax provisions, like I said, tax rates extension has the OBB extends it. So some planning consideration, obviously overall beneficial to all taxpayers. There is a 0% capital gains rates for taxpayers. You have to have income of about under 98,000, but this is a huge planning opportunity. So we want to focus on strategies that reduce above the line income to minimize impact on your adjusted gross income, and be cognizant of phase out of various deductions, which we'll talk about here. Next is the state and local cap deduction. So currently capped at $10,000. The OBBB increases the limit to $40,000 for 2025, followed by 1% statutory increases in the following years. Now, everybody gets excited about this. However, unfortunately, sorry to report, that incremental $30,000 begins to phase downward after $500,000 of household income. The incremental $30,000 completely phases out after $600,000 of income. So this is a perfect opportunity to time your income. If we can lessen your income based for planning purposes, it not only reduces your gross income, but it actually gives you the ability to sustain or increase that state and local tax deduction. I was actually playing around with some tax returns, and the difference between a $500,000 and a $600,000 earner is tremendous. Why? Let's say you're earning $500,000 and you have the full property and income tax that you paid in of $40,000, let's see, or at minimum. The difference between a $500,000 and a $600,000 earner, the $500,000 has the $40,000 SALT deduction. The $600,000 earner has no SALT deduction, only has $10,000 SALT deduction. So to increase your income by 100,000 also reduces your deduction by 30,000. So the increase of that incremental 100,000 actually increases your taxable income by 130,000. So that's just how powerful the planning for that SALT caps deduction really is. Now, if you're well above that or you don't have the ability to plan, that's one thing. But if you're kind of in that range of could we get below 500 for a particular year, or within that range, that's how powerful it actually is. Next, standard deduction made permanent. So the TCJA increased standard deductions with a temporary provision, like I said previously. The OBBB makes the increase permanent and provides annual increases going forward. So 2025 deductions are as follows: almost 16,000 for single, 23,625 for head of household, 31,500 for married joint. What you should know also is that for taxpayers that are 65 or older at the end of the year, they get an enhanced extra $6,000 per taxpayer of a standard deduction. So if two seniors are married and they're both over the age of 65 and they meet the income threshold, which we'll talk about in a second, they get an extra $12,000 standard deduction tacked onto their $31,500 standard deduction. Now, that enhanced $6,000 per taxpayer, if you're over age 65, unfortunately does phase out between 75 to 150 if you're single, and 150 to 250 if you're married. So for seniors, this really can impact timing of your retirement plan distributions and Social Security claiming strategies as well. Also consider bunching deductions to itemize. If again, we can get you into that under 75 or under 150,000 of taxable income. Maybe let's front load some charitable contributions deductions. Maybe let's front load some property tax payments. Maybe let's front load some mortgage interest payments, perhaps, all to take full benefit of that enhanced standard deduction for seniors. Next, we have the child tax credit. The OBBB increases the child tax credit from $2,000 to $2,200. And similar to the TCJA in prior years, the child tax credit does begin to phase out for married joint filers at $400,000 and up. Next, we have the charitable deduction for non-itemizers. So what we typically know is that charitable deductions is a type of itemized deduction. So we either take the larger of our itemized deductions or the standard deduction, right? And so if we go back real quick, the standard deductions are 15,700 or 31,500 for married filer. And so we either take the larger of the itemized or the standard. However, what the new law provides is an above the line, meaning without considering itemized deductions, the law allows a $1,000 deduction for single taxpayers and $2,000 for married taxpayers. So if you remember from 2020 or 2021 during the COVID years, you were allowed to take a $300 charitable contribution deduction, even if you took the standard deduction. That essentially works the same now as it did. So planning considerations, like I said, non-itemizers can deduct, and taxpayers using donor-advised funds or qualified charitable distributions from their retirement plans, they should do at least a little bit of a cash contribution, because that's the amount that's eligible for this above the line charitable deduction. Okay. Tax deduction provided for tips and overtime income. So this is a hot question that we've been getting, right? This was on the when the president was campaigning for himself, making tips and overtime not taxable. This is what was the result of it. So the OBBB provides a deduction, not an exemption, not a non-taxation, but a deduction for tip income, and 12,500 or 25,000 for single or married filers for overtime pay. It is not for all tip and overtime income. For overtime pay, it's only the incremental premium that you are paid for overtime. So let's say taxpayer makes $30 an hour. His or her premium is an extra 50%, gets paid an extra $15 for working overtime. Their pay rate for that overtime hour is 45. The deduction that is eligible for this deduction is only the $15. Then the deduction is determined actually on your 1040. So once we line up all of your income, it's based on, there is an income threshold where this deduction becomes eligible. So it's when your income exceeds 150 if you're single, or 300,000 if you're married, this deduction does begin to phase out. Now, I'm waiting to hear from the IRS on some guidance here, how overtime pay is going to be reported on to the IRS. Historically, overtime pay was just a number that was included in your gross taxable compensation on your W-2s. It was never specifically outlined on your W-2. We're waiting to hear from the IRS on how payroll preparers and providers are going to have to prepare that and not only inform the IRS, but inform the taxpayer and the tax preparer for that figure on that. And
I
not
just
only
want to
that,
add
yeah,
also,
John, yep.
yeah, I just want to add also for tips. So tips have always supposed to be reported separately. Now, I'm sure a lot of people in the restaurant business have been maybe cavalier in this, not always reporting tips, but now you're going to see pressure and more scrutiny. Your employees are definitely going to want their tips on their W-2 because they're not paying tax on them, and they want to be able to at least show a higher income. And so there's going to be more scrutiny on the reporting of this. So business owners, you have two things to really, in these industries, be wary of. Make sure you're properly reporting tips and overtime and issuing the proper reports to your employees, because it's something new and it will be a change for a lot of people.
Yeah, no, that's good guidance there, John. Also, the ability to report tip or pay your employee tips or overtime, it's not for all industry types. So for example, I can't have a staff person, I can't bunch their hours into 1 week, give them the gross number, but I can say that, a certain percentage of that is overtime, and I can't pay my employees in tips either. It's only for certain industries that are typically tip or overtime based type of compensation industries. Next, gambling losses. So prior to the OBBB, gambling losses were eligible to be deducted to the extent of your gambling winnings as an itemized deductions. In the OBBB, starting 2026, so not 2025, 2026, gambling will be able to be deducted only to 90% of their losses to the extent of winning. So let's take an example. Let's take you had $10,000 in losses and you had $10,000 in winnings. So you broke even for the year. 90% of your losses is $9,000. Your winnings is $10,000. You can only deduct $9,000 of losses against the $10,000 of winnings. So that's a pretty big modification there compared to the prior law. Now, let's say you had $100,000 of losses and only $10,000 of winnings. 90% of your losses is 90,000. You can fully utilize all those losses because 90,000 is no, you can't use all those losses. You can only use to the extent of your winnings. So again, $100,000 of losses, 90% of that, 90,000, you can only deduct to the extent of your winnings. So it's a two-step test there. Next, we have the auto loan interest deduction. This is a brand new one. This is an above-the-line deduction, not an itemized deduction. It reads, it is an deduction for up to $10,000 of interest paid on an auto loan for a vehicle that's assembled in the U.S., and the vehicle must serve as security for the loan. So let's say you take out a home equity loan to purchase to purchase a vehicle. You cannot use the interest paid on that home equity loan for purpose of this auto loan interest deduction. Also, this deduction phases out. It begins to phase out for income levels above 100,000 or 200,000 if you're married. Now, this is another one I'm still waiting on guidance from. For those with mortgages and mortgage interest figures, we're used to banks and we're used to the creditors issuing taxpayers a 1098, which essentially reports how much mortgage interest was paid in that particular year. We're waiting on guidance from the IRS on what kind of information will be, what kind of 1099 or 1098 form will these banks need to furnish to their customers to use for their tax returns. There might not be any for 2025. You might just have to use a year-to-date statement to use that figure for the purposes of the deduction, and everything obviously is subject to audit, but we're waiting to see again on how the banks will need to furnish that to the IRS if they will need to furnish it. So this is an opportunity for buyer of new vehicles. Keep in mind it's got to be financed. And it's got to be a U.S. assembled vehicle. So I'm sure the IRS will issue a list of which vehicles will be eligible for that for in the near future, just like they do for EVs. So pay attention to that. And when you are going to buy a vehicle, I'm sure your salesman should, if not already, they should soon be knowledgeable of if a vehicle does participate and is eligible for this type of interest deduction. But remember, not all taxpayers are eligible for it because there are income thresholds that are determined once we compile your individual tax return.
Also, let me just jump in. I know
Sure.
some people are going to be like, I borrowed money from my mother to buy the car. It needs to be a valid loan where you're reporting, paying interest, have it documented, and that person would be reporting income on the interest. So that's just something to be aware of.
And when I look at it, if we just high level look at the numbers, to have $10,000 of interest means you got to probably have a decent sized purchase price or the amount that you financed, and it is phased out for single taxpayers at 100,000. Not trying to pass judgment here too much, but how many taxpayers are paying $10,000 or more in interest if they're earning $100,000?
Yeah.
Next, rollback of EV and clean energy credits. So the OBBB rolled back the $7,500 clean vehicle credit for new electric vehicles and $4,000 for used EVs. This is for EVs purchased, or the elimination of the credit is for EVs purchased after September 2025. So if you go buy an EV today, you have about a little less than 2 months to take credit for this EV credit on your tax return. The home energy efficient credits. So this is for things like solar panels, energy efficient windows, heat pumps. These will be phased out slowly over the next over the next 3 years, 2026 to 2028. So if you're considering buying an EV, get into the dealership now and be sure to purchase that vehicle by the end of September. Same is true if you're thinking about purchasing and installing clean energy items in your home. Do it sooner rather than later. I mean, you have a little bit more time there, but just know that the phase out is coming. What I'm hearing from people in the auto industry is, yes, we know taxpayers might lose the $7,500 credit on their tax return. I'm hearing that just naturally based on supply and demand and market drivers that EVs might come down in price to keep incentivizing consumers to purchase EVs, but I guess we'll have to see. Next, itemized deductions phase out. So this is something called the PEAS limitation. This is a fairly complicated calculation, but just know that prior to the OBBB, there were no limitations on itemized deductions. However, beginning in 2026, itemized deductions are reduced by 2/37 of either the excess items or income above 37% threshold. So just know that there is planning here to be done. If you just shove all these charitable contributions down, or you have high medical expenses or a lot of mortgage interest, and you're planning to take all of it, just know that starting in 2026, that there will be some limitation here. Plus, it starts in 2026. It doesn't start in 2025. So if you're thinking about all those items, interest, taxes, charity, perhaps shove them into and front load them into 2025 before this PEAS limitations, it's called, or this phase out of itemized deductions takes place. Trump accounts. This is a new add-on. Again, President Trump was talking about this during his campaign a bunch. It is a pilot program where the federal government pays a one-time $1,000 amount to an account of each qualifying child born after 2024. Parents and others can contribute up to $5,000 yearly for the child to use after attaining age 18. After age 18, the account essentially follows the same rules in place for IRAs, well, Roth IRAs. So contributions by parents and others are not tax deductible, similar to a Roth. And then there are some rules on distributions and penalties and things like that. We are waiting for more guidance on the actual setup, the actual rules with all this. But just know that keep track of these accounts separately from your other IRAs, because if you're going to pull from it after or your child is going to pull from it after age 18, you have to track them separately than other IRAs. Personally, I haven't heard of any banks or the president or the government starting to issue these $1,000 amounts, but just know they were in effect starting in 2025. And then other OBB provisions made permanent. So the mortgage interest deduction limited, it's the mortgage interest limited to the first $750,000 of loan balance for any mortgage borrowed or initiated after December 2017. It keeps that $750,000 limitation in place. What it does also bring back is the deduction for PMI. The TCJA got rid of the ability to deduct PMI, but it does now, OBB brings it back. You can deduct PMI if your income is under 100,000. Quite a low threshold, but PMI is back as an eligible deduction. The OBBB does also, unfortunately, makes permanent the inability to deduct unreimbursed employee expenses. We've been getting this question so frequently over the past 6 or 7 years, and we still get them all the time. Hey, Rob, I work for an employer. I incurred expenses on behalf. Unfortunately, I'm sorry, those are not deductible. What you have to do, you have to go back to your employer and say, hey, here's my receipt. Please reimburse me for it, and it should be a non-taxable reimbursement. Okay. Now we'll head over to business tax provisions. So the qualified business income deduction. So this was an excellent this is an excellent deduction for individual taxpayers based on their eligible or their qualified business income. It's up to 20% deduction on your business income. The OBB makes the 20% QBI deduction permanent. There are phase-out limits, income limits on this deduction program. Those have been increased. And an actual new $400 deduction has been added with taxpayers with at least $1,000 of QBI. So for business owners, this is a huge planning opportunity to keep your incomes within those phase outs. There are two different types of businesses. There are specified service businesses. There are non-specified service businesses. Each of those different types of businesses qualify for certain different types of income thresholds. So this is a excellent planning opportunity to reduce your taxes.
I would say, Rob, I think that this is the area where I see people kind of leave the most out there by not really planning and maximizing their QBI deduction, especially small business owners, because the type of entity, how you, if you're an S corp and running salary, there's a lot of opportunity to plan, and sometimes it's just some simple steps that a business owner can take that can be a big difference.
Yeah.
So if you're not looking out for this, make sure you are, especially going forward.
Yeah. Great. Thanks, John. Next is the PTE, pass-through entity tax SALT deduction. So for business owners here, especially New Jersey, New York, and 34 other states, if you have a pass-through entity, which is a partnership or an S corp, the PTE remains. We were hearing, because of the increase in the SALT deduction, we were hearing that the PTE was going to go away. This would have essentially made the incremental $30,000 SALT deduction a nil change in your tax bill, or actually could have hurt you depending on your PTE income. But at the last second, they actually continued it, allowed it to continue. And the PTE, the OBBB makes the PTET permanent, and there is no limitation. This is massive for New Jersey, New York, and 34 other states. Business owners. Now, being in New Jersey, I know, New York, I know both PTE programs fairly well. You can be an LLC, but you have to be a multi-member LLC. What's a multi-member LLC? Multi means more than one. Two is more than one. So you either need to be a partnership, meaning two or more partners, or you have to be an S corp. Both of those partnerships and S corps are considered pass-through entities, and those are eligible for the PTE. So can I be a single owner of an entity and still get the PTE? You can't be a single member LLC because that's not a partnership, but you can be a single shareholder S corp owner. Now, does it make sense to go S corp? There are some other costs, some other disadvantages. There are a lot of other advantages, but the moral of the story is there's a lot of planning opportunities here. The PTE deduction, it has been made permanent. So please plan for this. Talk to your tax professional. Tell them to review your entity structure, review W-2 compensation structures. If I'm not participating in PTE, you're really leaving a lot on the table. The PTE does not cost you really more money. It's really an arts and crafts project, what I call. We have to file 1 or 2 extra forms to kind of get you enrolled in it, and on an annual basis. It is for many small business owners, it is an absolute no-brainer. And again, if you can hear from my voice, and I'm absolutely thrilled that this continued, especially for New Jersey and New York business owners. Lastly, we have the 100% bonus depreciation restored. So as we go towards the back, half of the year, this is an excellent opportunity. So prior to the OBBB, like I said in the couple opening slides, the TCJA provided 100% bonus depreciation for certain assets, but then that 100% began to get depleted every year. 2024, it was up to 60% of eligible property, but the OBBB restores it back to 100% for assets placed after January 19, 2025. So pretty much all of 2025, if your asset was placed into service. Not all assets, so not real estate, not other leasehold improvements, but there is a lot of eligible capital improvements that are eligible for 100% depreciation. So huge planning opportunity there. If you can make a large asset acquisition before the end of the year, then it could be potentially 100% depreciated in the first year, where before the OBBB, 2025 was set up for a 40% bonus depreciation. It was 60% in 24. 25 was set up for a 40% bonus depreciation. The OBBB restores it to 100%. So if we're looking back at a lot of the provisions that we just talked about, business, individual, a lot of these are phasing out at $200,000, $500,000, $600,000 of income. If we can make a capital asset investment before the end of the year, you could take potentially if it's the certain type of asset, which many are, then you can take 100% deduction on that asset. You take 100% deduction, you reduce your business income, you reduce your taxable income. Now you can probably be eligible for more deductions if you're kind of in those $200, $500, $600,000 thresholds, and you're nearing those thresholds. So again, huge opportunity here that the OBBB did restore. Just a heads up with depreciation and bonus depreciation. Many states do not file or do not follow 100% bonus depreciation. New Jersey and New York do not allow for it. So make sure when you're following federal and your state depreciation rules, that just because an asset qualifies for 100% depreciation in the first year does not mean that it'll be allowed on New Jersey or New York return. Doesn't mean it's not worthwhile, but doesn't mean that your New Jersey income is going to be reduced to the extent that your federal income is reduced because of this capital asset purchase. Okay.
And just one additional thing on bonus depreciation that I think is great is that when you buy an asset, you can finance it. So if you buy equipment for $50,000 and you only put down $10,000 or $20,000, you can still get a $50,000 deduction. So you're spending, $10,000 or $20,000 to get a $50,000 deduction. And sometimes with real estate, or it can be even much greater than that. So it can be a great way to reduce your income and increase your cash flow.
Yep. Yeah. No. Yeah. Yeah. It's an excellent example. Why wouldn't we maybe want to take bonus in a particular year? If we need to show certain types of income amounts for credit purposes, if you're going for a mortgage or business financing, we might want to not deduct as high of a bonus, and we have the option to bonus something or not. Also, depreciation recapture. So the way that works is if I deduct something, if I buy, let's take a piece of equipment in year one, and I deduct 100% of it, but then I sell it the following year for more than what or in a future year for more than I paid for it, because the asset appreciated in value for whatever reason, I have to pick up in income the amount that I depreciated in the first year as ordinary income, and then any incremental excess above the original purchase price needs to be capital gain. So if I know this year is a kind of lower income tax bracket year compared to when I might sell the asset, it might not make sense to hurt yourself or help yourself this year with a smaller tax benefit if it's going to cost you more when you're in a much higher marginal tax bracket in a future year. So plan ahead. And you might not know that might happen in the future, but if we do know, or you're eyeing an exit from a business, and maybe you're going to start taking RMDs, or your spouse's income is going to go up, or your income is going to go up, that might be a reason why you might not want to take bonus depreciation. Great. All right. And like I said before, there are a few more business tax provisions that which are not covered here. A couple of them are R&D tax, R&D expensing, and then QSOS, qualified stock, Section 1202, being able to exclude gain on C Corps, that typically for tech companies, if you're an original investor, you can exclaim or exclude up to $15 million of gain. We didn't cover them for here, but just know, R&D tax expensing and the Section 1202 have been extended and enhanced in the coming years. All right, and that's from me. John, take it away.
So I'm just going to go over a little bit about what's going on with the IRS and some enforcement issues with the IRS. So, it was obviously a hot topic when President Trump came into office, that they, were doing DOGE, reducing government staff, reducing spending. So how has that affected the IRS? So since February, it's estimated that there's 26,000 less employees, which is about it's more than a 25% decrease. Okay, the areas, about 27% of IT staff is reduced, 22% of taxpayer services is reduced. Um, we've seen basically the IRS offered buyouts to employees before doing layoffs, and the layoffs that, with the government, people that have seniority, were less affected. So it was a lot of new people, and the people we found that were taking the buyouts tended to be a lot of people that were attorneys or more senior. They had, better payouts, so a lot of people chose to take them. And how is that affecting taxpayers? So I would say the best way to look at it is there's increased wait times for things involving humans. Okay, so so if you're being audited, there's less auditors, and there's a lot less audit appeal officers. So those are taking much longer. Okay, if you're applying for an offer in compromise, these are taking much longer. If you owe the IRS more than $250,000, those cases often are assigned to revenue officers. Cases over $1 million are automatically assigned to revenue officers, and those cases are taking much longer to resolve. We've seen a lot of, in case, it's calmed down a little bit, but we were finding situations where we'd be in an audit and the person we're working with kind of disappears. And when we found out, they retired or were let go. And this is just, it's happened a lot this year with the IRS. So cases are moving from people to people and things are taking longer. I'm not sure if people here are aware of something called the Taxpayer Advocate. It's like an independent group within the IRS that advocates for taxpayers. So they're very helpful for certain things, like if if things are being delayed with the IRS, if your a return isn't processed, a payment didn't go through, or you're having a difficult agent. Sometimes the taxpayer advocate was good at expediting things. And they used to, you'd file what was called the 911 request, and they would get back to you within 30 days. So now, we're seeing that it's closer to a 60-day response time, okay? And sometimes longer. So that was kind of a little bit, that was a way to get things expedited, and that's taking much longer. What I would say is, sometimes, you can use this to your advantage, because if you have tax debt that may expire and there's no agent, you're not in a rush. Or if you're sometimes, you can, if you get an auditor, or an appeals officer, they're very busy and they're looking to get things done, maybe you can get a more favorable outcome. But, just be aware that things are just taking a lot longer.
John, how does one get a taxpayer advocate assigned to them?
Sure. So you file a form. It's a 911 form. That's actually the number of the form. So you file this 911 request. There are local taxpayer advocates offices in each state. There's several in New Jersey, but they're just have a lot less staffing now than they did last year. But it's definitely, if something's like, I say, if something's stuck, you're trying to get something processed, or you can't get through to them on something, they can be helpful, but just not as quick as it used to be.
Got it. Great. Thanks.
We can go to the next slide. Okay. So automated enforcement. So this is really important, and I think people need to be aware of it. So during COVID, the IRS stopped issuing what we call automated levy notices, LT11. And what they were doing, so LT11 is an intent to levy. So this is for people that owe the IRS money, okay, and haven't paid and are not in a payment plan or a settlement. The IRS will send a series of letters. And once you get this LT11, within 30 days, if you didn't respond, the IRS can actually levy your bank account, okay, or garnish your paycheck. So during COVID, the IRS stopped acting on these levies. They stopped issuing these LT11s, and they would only do these levies if an agent was assigned to your case. So as we see, there's a lot less people working at the IRS, And so the IRS has gone back to doing automated levies, okay? Meaning there's a lot of people that think, hey, nothing's happened. They owe the IRS money. They've kind of been ignoring them, ducking them. You can't really do that anymore because they will now just automatically at a certain point send this LT11 and you can have your bank account levied, your wages garnished. And so they just did this literally a few weeks ago. They sent out over 100,000, and we're told by some people at the IRS that by the end of the year, it's going to be over 1 million of these notices. Okay. Another thing is automated passport revocation. So right now, if you owe the IRS 62,000 or more and you're not in a payment plan or settlement, the IRS can send a letter to the State Department, okay, telling them to not renew your passport. And you will get a letter as a taxpayer saying, we have certified your tax debt. We've notified the State Department to not renew your passport. Okay. And, I would say at a minimum, it will take 30 days for you to get back in the good graces with the IRS for them to then notify the State Department. Okay. So, as we're talking about less people, this can take even longer. Okay. So if you have a trip or someone that has a trip and they need to renew their passport, make sure you're dealing with your IRS tax debt. We've had, some very sad cases of people, unable to make funerals, weddings, visit sick family members because of this issue. Okay. And, one sort of positive, well, I don't know if it's positive, depending how you look at it. The IRS is trying to be better at using technology. And so they're kind of now getting a little better at when you get a W-2 1099s, that gets all reported to the IRS, right? That gets sent by the company to the IRS. And when they look at your return, they can see, did you report that or did you not? Okay. And they're doing more, instead of human audits, what we call income adjustments or correspondence audits, where if they see things are not matching, they'll send you a letter and then you have to respond explaining, why your return is correct or what the mistake was and try to fix it. But it's more automated. There's less humans involved. You have to respond correctly. So a lot of times people get the letter and, they'll respond to the wrong place and they'll be waiting months, nothing happened. There are specific instructions on each notice on how to respond. And if you don't respond or respond properly, the IRS will eventually assess tax against you. So it's just being more automated. It's more assembly line like, where send a notice. If they don't get the proper response at a certain time frame, it moves to the next level and then it gets assessed against you. So you really need to deal with these notices and use the IRS now has a document uploader tool. So for the CP 2000 and the correspondence audits, you should be able to upload these tools to the IRS, your documents. I would definitely recommend anytime you need to communicate with the IRS, upload the documents as opposed to mailing something. Fax is not great with the IRS. There's like a 50% chance they don't get it if you fax something. Try to use the upload tool as much as possible. If you mail something to the IRS, and sometimes you have to, make sure you mail it certified receipt and keep track. We've had cases we've mailed things certified receipt and it still doesn't go through. It's a challenge dealing with the IRS. So be proactive. I said any outstanding IRS issue you have, be proactive. You don't want to get in the weeds to them, especially if you have, let's say you need to get a loan, you're looking to buy a house, you're looking to buy a business. You need to have your IRS issues resolved because it's not going to happen overnight. And we see that sometimes where people want everything tomorrow, but as you can tell, things don't happen overnight with the IRS.
Great. So, John, thanks for that update. That's excellent. I know you're a bit more tuned in to IRS procedures and enforcement. So, thank you for that update there. So we have a few minutes before the full hour is up. We're not going to shut it off, but we have a few minutes until 2 o'clock. So just wanted to say thank you, everybody, for attending. I hope you got like a little bit of an intro to certain things that are going to be made permanent and some planning opportunities. And really, I hope you're not ready to make decisions yet. I hope you're ready to ask more questions. That's really the goal is, to go back to, hey, I heard about this. Is this really for me? Is it not right for me? And talk more planning with your professional. So from our perspective, that was today's goal. And now, any questions from anybody, please type it in. Please go ahead. I know we have one here. Is the phase out on SALT based on gross or your AGI? It's based on your modified AGI. Modified AGI is not taxable income. Modified AGI is your gross taxable income, less certain deductions. So health insurance deduction, retirement plan deduction, maybe an HSA deduction, and then it's modified for certain other aspects. For most taxpayers, modified AGI is AGI, but if you have tax exempt interest, that which is not taxable, that could be modified to AGI. But again, the SALT deduction is based on AGI, modified AGI, not taxable income. Okay. Any other questions?
We were so thorough and just blew everyone away, I guess.
You have all the answers. Awesome.
Um,
Awesome. Well, I won't hold anybody. We haven't held anybody, but if you're free to go. Class is dismissed. But if anybody else has any questions, we'll stay on for a few more minutes. Okay. Thanks for joining, everybody.
Thank you very much.
Rob. Thank you, Jonathan.